Imagine you are running the world's biggest economy. You are already drowning in debt, borrowing nearly $4 million a minute, barely keeping the lights on. Then, just as you start another quarter expecting a cash pile of $850 billion, you find you only have half. And at that very moment, your biggest lender turns, walks out, and slams the vault shut behind them. This isn't fiction. This is what happened when China planned to unload $1.7 trillion in U.S. debt. A move so devastating that it didn't just terrify markets. It humiliated Washington's entire financial machine. The U.S. Treasury was forced to borrow $514 billion in emergency funds just to stabilize its bleeding balance sheet. The dollar tanked. Mortgage rates soared, inflation came back. And around the world, once loyal allies began pulling out quietly, strategically, and fast. So what really happened? And what if this isn't the peak, but just the beginning? In this video, let's break it down. It didn't come with speeches, press conferences, or red flags. It came with numbers, sharp, quiet numbers that cascaded through global bond markets like precision-guided missiles. China's decision to slash its holdings of U.S. treasuries wasn't some erratic reaction or spontaneous maneuver. It was a premeditated strike, an economic ambush aimed directly at the heart of American financial stability. And it didn't happen in isolation. It followed a very specific provocation. The U.S. government's directive that forced J.P. Morgan and Bank of America to pull out of underwriting a $5.3 billion IPO by a major Chinese electric vehicle battery manufacturer. While Washington framed the move as a national security issue, citing ties between the company and China's military-industrial complex, Beijing understood it for what it was: financial warfare. And instead of retaliating with noise, China retaliated with silence and liquidation. In the weeks that followed, Chinese institutions quietly unloaded over billions of dollars in U.S. Treasury bonds, reducing their exposure to just $759 billion, the lowest level since 2016. But Beijing didn't stop there. Alongside the sell-off, it ramped up its gold reserves to 2,292 tons, marking a fifth straight monthly increase. Gold, the oldest hedge against monetary manipulation, was no longer just a safety net. It was a message, a statement that China no longer saw U.S. treasuries as reliable stores of value. In Beijing's eyes, the American debt market had become a trap, a system where political conflict could instantly translate into financial blackmail. Treasuries, once safe, had become toxic. And if the U.S. wanted to weaponize its financial system, China would show it just how much damage that system could inflict, from the outside. As Beijing began systematically exiting its role as America's largest creditor, Washington found itself caught completely off guard. Entering the second quarter of 2025, the U.S. Treasury had confidently projected it would have $850 billion in cash on hand, more than enough to manage federal obligations and fund its expanding fiscal commitments. But when the quarter opened, the government discovered that its actual cash buffer had plummeted to just $46 billion. The collapse was stunning. Officials scrambled to secure emergency funding, eventually borrowing an eye-watering $514 billion, a 317% increase from what they had forecasted just 2 months earlier. The reasons for the shortfall were manifold, but the root of the crisis was a dangerous blend of arrogance and outdated assumptions. Policymakers failed to account for the speed and severity of foreign capital flight, particularly from China. They didn't anticipate how quickly decoupling from Chinese capital would reduce tax receipts and shrink financial inflows. Most damningly, they continued to rely on projections that assumed a stable bond market, even as their largest buyer walked away. Wall Street traders had seen some of the danger and expected an elevated borrowing figure of around $255 billion. They were even shocked when the real number came out to be twice that amount. The Treasury wasn't just wrong, it was lost, operating on financial maps that no longer matched the terrain. And in an environment where every borrowing decision affects bond yields, investor confidence, and interest rates, getting it wrong isn't just a mistake. It's a crisis which the United States manufactured on its own. You see, the collapse of trust between Beijing and Washington didn't start in bond markets. It started in boardrooms. The Trump-era tariffs were revived with fanfare in early 2025 under a bipartisan push to protect American industries and punish China's technological expansion. In reality, the policy acted like a boomerang, striking American interests just as hard, if not harder, than it hit Chinese firms. When J.P. Morgan and Bank of America were ordered to back out of the IPO of a strategic Chinese EV battery manufacturer, it wasn't just a lost deal. It severed the U.S. from a financial ecosystem worth trillions, one of the most dynamic, rapidly growing sectors in the world. Beijing didn't lash out verbally. It executed a deeper, more intelligent response. It weaponized its dollar reserves. U.S. multinationals were hit next. Apple, already stretched thin from supply chain disruptions, reported a projected $900 million loss for Q2 2025 as a direct result of new tariffs. Internal communications, later leaked, revealed discussions about raising iPhone prices just to maintain margins. Nike, Tesla, and even agricultural exporters began preparing similar moves. Before we continue further, tell us, are you enjoying the video? If yes, please like and share the video and subscribe to our channel to watch more videos on the latest news stories on geopolitics, economics, and current affairs, impacting your lives. The ripple effect was immediate and far-reaching. Prices on consumer goods rose. Retail confidence shrank, and all of it fed back into a spiraling inflation curve. What policymakers failed to understand is that in a hyper-globalized world, tariffs don't just punish the other side. They punish the customer. And when the other side holds your I/O-US, there's no firewall. You can't strong-arm your biggest lender in one room and ask for more loans in the next. Washington had launched a trade war against the country that held its debt, and it was now paying the price in credibility, in capital, and soon in consumer backlash. While Washington's elite argued over bond strategies and fiscal plans, average American households were living the consequences, line by line, bill by bill. In the weeks following China's Treasury dump, bond yields spiked dramatically. The 10-year yield crossed 4.6%, peaking near 6% in May 2025. The immediate result? A borrowing freeze on Main Street. Mortgage rates jumped to 7.8%, the highest level in over 15 years, pricing millions of families out of home ownership. First-time buyers were especially devastated, many finding that the monthly payment on a modest home had increased by hundreds of dollars overnight. But the pain didn't stop at housing. Auto loan rates surged past 9%, turning affordable vehicles into luxury purchases. Student loan interest hit 6.6%, making education less of a stepping stone and more of an anchor. Simultaneously, inflation crept back, not from wage growth or domestic overspending, but from the dollar's weakened position in global trade. The cost of imported essentials rose sharply: fuel, medicine, electronics, even food staples. The Consumer Price Index surged to 3.4%, with core inflation dragging household purchasing power down by over 5% year-on-year. Families weren't reading economic forecasts. They were feeling them at the gas pump, in the grocery store, in college tuition statements and utility bills. And all of it can be traced back to a single catalyst: China's exit from America's debt market. They didn't launch missiles. They didn't cut off trade. They simply sold, and the shockwaves hit every kitchen table in America. It was proof in the most brutal terms that the world's financial war wasn't being fought in conference rooms. It was being fought through interest rates. And the people losing weren't politicians. They were ordinary citizens, used as collateral in a debt-fueled standoff that their leaders didn't see coming, or worse, didn't care to prevent. However, the real humiliation didn't come from Beijing. It came from Riyadh, Brussels, and Tokyo. In the first quarter of 2025 alone, $317 billion in U.S. assets were sold off by foreign holders, the largest retreat since 2016. Saudi Arabia trimmed its treasury exposure by 22%, now holding just $126.4 billion. Meanwhile, BlackRock and Vanguard were forced by Congress to divest nearly $812 billion from Chinese companies, a move that spooked the global investor class and made American financial policy look more like geopolitics than economics. Asian IPOs on U.S. exchanges? Down to 28% from 75% in 2022. Tokyo and Frankfurt? Booming with new listings. You see, it's not just a capital shift. It's a confidence shift. And Washington is no longer the obvious place to park your money. Now, while U.S. institutions try to patch the leaks, China is building a new system from the ground up. A national credit rating agency will launch in 2026 to rival Moody's and S&P. China's internal cross-border payment networks are now SWIFT independent, and BRICS Pay processed over $56 billion in Q1 2025 alone, half in local currencies. This isn't theoretical anymore. These are living, functioning replacements for the Western-controlled financial order. Beijing isn't breaking the rules. They are replacing the entire rulebook. Now, the question arises, can the U.S. Treasury keep up, or has the clock already run out? Treasury officials now project borrowing needs of $514 billion in Q2 and $554 billion in Q3, hoping to rebuild their liquidity buffer to $850 billion. But as of May 2025, cash on hand was still 33% below that target. J.P. Morgan warns that markets are losing patience with Washington's optimism. Rating agencies are preparing to reassess sovereign credit outlooks. Foreign lenders are tightening. And there's growing skepticism about the U.S. government's ability to finance its own policies without devaluing its own currency. The truth? The world is watching. And the cracks in America's economic armor are no longer hairline fractures. They are fault lines. What do you think? Does China hold leverage over the U.S. because it is the largest creditor? Isn't it true that China can unleash a devastating financial crisis on the United States anytime it wants, using the U.S. Treasury bonds? In the comment section below, share your thoughts on the fact that Trump always engages in a bluff game with China because, deep down, he knows China is in control. Do you want to watch more videos like this one? If yes, subscribe to our channel and press the bell icon next to it. We bring the latest news stories on geopolitics, economics, changing world order and current affairs, things you need to stay informed. Thanks for watching, and until the next video, stay tuned.